Another wild week in the markets. There are some big time businesses that released their earnings this week, causing massive swings both up and down. And as I record this, we're waiting on two more mega giants to release their earnings after the market closes, Microsoft and Google. And on top of all of that, the market is reacting again to broader negative macroeconomic news. But today's focus is on a financial data firm that continues to just make money and compound free cash flow. Welcome to The Quality Investor. A key aspect about the market is that it's forward-looking. It's important to keep that in mind when earnings are released each quarter. We can see very healthy top and bottom line growth in the investments that we own, yet when their earnings are released, we can see drops of over 10% in the market. It can be very disconcerting when we see that, and it forces us to reevaluate our investments. We have to remind ourselves why we own the business in the first place. We have to ensure that our investment thesis remains intact. This was the story earlier this week for MSCI. Each quarter, MSCI seems to post earnings growth and free cash flow growth like clockwork. It's almost expected every single earnings release. So when we see a great earnings report, yet the market sends them downwards, we have to go back and see if we didn't miss something in our own investment thesis. The market is a lot smarter than what we give it credit for sometimes, and large drops in some of our investments force us to become better investors in the long run. So I want to quickly get into what my investment thesis is for MSCI and what I believe is their economic moat. But first, remember to hit that like button below and make sure to subscribe to the channel so you can stay on top of all the quality businesses in the market. So my investment thesis for MSCI is as follows. MSCI has a scalable product and service offering, meaning for every new product sold, there's not an additional cost, or at least a very marginal cost, to acquire that sale. This leads to very healthy margin expansion. Secondly, they're a global leader, along with S&P Global, for benchmarking indices that fund managers use to assess baseline performance. Once an MSCI index is used as a benchmark, it's very unlikely that that fund manager will switch benchmarks in the future. To do so might lead to a considerable drawdown of assets under management for that fund and thus lower fees. Third, they have a very strong revenue subscription model, generating over 75% of all revenues across all segments from subscriptions. And fourth, they're the unquestioned global leader in assets under management for ESG-linked ETFs with over 50% market share. It's also MSCI's fastest growing segment, and MSCI management believes that high growth will continue for the long term. So all of that means that their economic moat comes in the form of switching costs. Once a fund manager selects an MSCI index as a benchmark, that's it. That's the benchmark going forward. Investors in that fund expect to measure that fund's performance against that benchmark. And the same goes for ETFs linked to MSCI indices. Let's take a look at this article on MSCI from the Substack Analyzing Good Businesses. Passive ETFs benchmark indexes define the underlying exposures to specific securities, and the ETF managers need to license that data. So MSCI gets paid a percentage of AUM in the ETFs. So there's two things going on there. MSCI has to license this data, meaning they get that subscription revenue, plus they collect an asset under management fee along with that. Currently, they have 1.5 trillion assets under management for their ETFs. The same goes for the analytics segment as well. MSCI Analytics segment also benefits from switching costs, like other enterprise software providers. Customers of the company's analytics tools and software build knowledge and expertise over time. Furthermore, as customers embed the analytics tools more into their workflows, it becomes more difficult to switch to another vendor. Now, obviously, there is a bit of a risk there because there's a lot more analytic software out there. But once you have an installed software base, it tends to stay that way. You can see that when this article was written, their retention rate was nearly 95%. And at the end of 2023, it was actually over 96%. There's also a high barrier to entry component. Government regulators, especially in Europe, have certain stipulations to become a benchmark in the first place. Benchmarks are required to meet certain standards, so that prevents new competition from easily entering the market. So now that we understand what the investment thesis is and what their economic moat is, we have to look at their earnings release and see if any of those attributes were broken. So let's dive in and see why MSCI fell over 13% in one day. So just looking at the initial summary for MSCI, we can see some very positive numbers here. Operating revenues of $680 million, up 14.8%. And more importantly, organic operating revenue growth of 10.3%. Recurring subscription revenues are up 15.2%, and their asset-based fees are up 12.9%. So both of those point to very strong growth year over year. One downside, however, though, is we can see that their operating margin went down to 49.9% from 53.1%. So with a business like MSCI, margin contraction like that signals one thing: loss in subscribers. Remember how I said that they have a retention rate of over 96% at the end of 2023? Well, here in this report, it's at 92.8%. So that's the first thing that we see about MSCI that I think caused the big drop in the market. In this paragraph, it says it right here. Retention rate in the first quarter 2024 was 92.8% compared to 95.2% in the first quarter of 2023. Approximately 7 million of the cancels related to one client event related to a merger of their banking clients. This impacted their index, ESG, and analytics segments. So the majority of first quarter 2024 cancels were due to corporate events, including organizations closing, shutting funds, and restructuring or downsizing. On the earnings call, the CFO clarified that these cancellations were primarily due to a global bank merger. He noted that some minor cancellations might continue, but they do not anticipate cancellations at a similar level moving forward. So this appears to be a one-time event, and we should see that robust growth going forward the rest of the year. Another thing I want to point out related to their operating margin, there were some significant operating expenses, about $35.1 million, associated with some acquisitions in this quarter. So those acquisitions, of course, are one-time events, and I don't think they're reflective of what we'll see the rest of 2024. So you can see, despite those cancellations, the incredible top-line growth for revenue, 14.8% year over year. And while it's not great to see your operating margin shrink, I do think it's a one-time event that will improve the rest of 2024. Also, their diluted earnings per share was $3.22, up from $2.97 a year ago, an 8.4% increase. So despite the elevated expenses, they still had strong earnings growth. And despite that lost revenue from the subscription cancellations, look at their operating cash, $300 million in this quarter. And deducting out their capitalized expenses, $20 million for the software and $4.2 million for regular capital expenditures, that gives us $275.9 million in free cash flow. That's an almost 14% year over year increase from last year's $242.5 million in free cash flow. I've always discussed on this channel the importance of free cash flow, that growing free cash flow over time is what will grow our investments. And you can see that MSCI did that despite the one-time troubles that we saw. So the last thing on the earnings release I want to look at is their full year guidance. The important takeaway here is it remains the exact same as what their guidance was at the end of Q4, meaning that they didn't revise any expenses upwards or any of their cash flow downwards based on this quarter's results. And if you take the low end of their free cash flow estimate, $1.2 billion, that's still a 7% increase year over year. So despite those one-time cancellations, and the market did not like that, but they dropped them over 13%, nothing in this earnings report indicated that my investment thesis was harmed in any way. Also, I don't see any erosion of their economic moat. What I do see is more free cash flow in my pocket as an investor. So I did update my valuation with all the latest information here. So let's take a look at what my numbers show and what I think a good buy price is for MSCI. So the first thing I want to point out is their current quarter trailing 12 here. They're up 14.7% year over year on a trailing 12 basis. They still have a 53.8% operating margin, and their free cash flow is still at a 45% margin. So looking at the year one beat miss column here, what this is telling me is that with the latest numbers in this release, I'm on track to actually beat my revenue estimate by 0.3% and my free cash flow by 1.6%. That's if they continue on their current growth trajectory, which is, in my estimation, conservative. The next thing I want to show you is my year one estimates for the important metrics here. So my operating margin percent for year one, I'm estimating that now at 52.75%. I actually dropped that from about 53.5% at the beginning of the year. And based on the expected interest expense, I have that margin at 12.75%. That's interest expense over operating income. The tax rate is at 19%. Finally, when I factor in their estimates for guidance and my estimates on revenue growth, if they hit the low end of that guidance, I have their free cash flow conversion coming in at $1.14, meaning for every dollar of net income, $1.14 of that will become free cash flow. And their dividend should come in at $6.40 this year. And I have a 13% growth rate on that dividend. I'll show you how that all ties together in a second. On a 10-year basis, I expect operating margin to grow to about 56% and free cash flow to convert to about $1.16, meaning relatively flat. And due to the amount of cash that MSCI generates, share repurchases should come to about 2% per year. So you can see, plugging in all of those growth estimates for their operating net margin and free cash flow margin and so forth, that'll give us a revenue growth over the next 10 years of nearly 9%. For context, management's actually expecting revenue growth to be in the low teens. Operating income should grow about 9.2%, earnings at about 10% per year, and free cash flow, it's growing at 9.6%. You look at their 1, 3, 5, and 10-year growth rates historically, free cash flow has never grown anything less than 12% a year. So I am expecting a bit of a slowdown based on our historical numbers, but still very robust growth going forward. I think the real power in MSCI is in their ability to grow their dividend. You can see the 5-year compound annual growth rate for the dividend is at 23.5%. And they have incredible growth over the entire history of their dividend, which is about 9 years now. Another thing I want to point out is they have a free cash flow payout of 38.5%. And you can see that typically the highest that their free cash flow payout has been. Now, I said I'm estimating their dividend to grow at 13%. To make sure that number makes sense, based on their share repurchases and how much free cash flow they expect to generate in the next few years, that free cash flow payout percent projected going forward remains to be around 40%. So I don't think it's unreasonable to expect their dividend to grow to about 13% per year. And then on a perpetual basis, dropping that dividend growth rate down to about 7.06%. That's important because it's under their free cash flow growth rate, which is at a little over 9%, meaning they're going to have plenty of free cash to fund that dividend going forward. So in tying all of that together, we're looking at a valuation average here of about $558.68. That's an upside of 20.9%, at least given their share price as of this recording at $462.12. At a 10% margin of safety, that's an acceptable buy price of $502.82. And at 20%, $446.95. At a 20% margin of safety, their forward PE is at 33.1, which falls just under their 10-year average. So right now, historically, MSCI is actually fairly cheap. So I'm comfortable with a 15% margin of safety. I've been waiting for MSCI to drop in price because I really did want to add some more, and that would put their acceptable buy price at $474.88. After their fall on Tuesday, I did add quite a bit more to my position. I was very happy to see them actually come in to a much cheaper price, so I took advantage of that. You can see today they're down about 0.5%, but that's not bad given the rest of the market. So I think MSCI had a very strong earnings report despite the subscription loss. And going forward, they're in a very strong position to continue their very strong growth. I think the market will kind of realize their mistake over the next few months, and we're going to see some healthy growth going forward for MSCI, so long as they keep posting these very good numbers. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.